Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello, everybody, and welcome to another edition of the Mentor Podcast. This is Ron LeGrand, and I have with me today Mr. Scott Meyers, the champion of self-storage, which is a discussion we get a lot of requests about. Scott has been in the self-storage business a long, long time, and he is a frequent guest on our stage at our commercial boot camps. So welcome, Scott. And I'm going to leave it up to you to lay out the reasons why we all should be in self-storage.
Yeah. Hi, Ron. Well, good to reconnect once again. And boy, the reasons are numerous. Where would you like me to begin?
Well, let's learn a little bit about you and why we should believe anything you have to say. How about that?
Sure. Well, I got into the business back in 1993. Started out with single-family homes by following a gentleman who had a number of programs, one on pretty houses, one on ugly houses. That sound familiar?
Who would that be?
None other than you, sir. And after you had visited our local RIA here in Indianapolis, and so I went out, took the business that you had laid out, and followed it. And so we were in the ugly house business and turning them around and renting them out. So I became a landlord for a number of years, and that wasn't as lucrative as I had hoped for. I didn't have as much free time and cash that I thought, as most people, when you're starting out, there's that critical mass you need to have before you kind of get over the hump and things begin to work a little bit smoother. So I got into apartments at that point. I'm looking to make that jump, and assuming that would work as well by having property managers run the properties for us. Well, unfortunately, we got caught, in the aftermath of the recession in '99, which is when the sitting president enacted the Community Reinvestment Act and allowed anybody that could flip a mirror to go out and buy a house, which is good for the other folks that were listening to your other program, Ron, on pretty houses. But we had a whole bunch of houses that were rentals, and so we were very quickly trying to get those rehabbed and turned around so that we could sell those off. And in the meantime, then, still dealing with the challenges of tenants and toilets and trash, and just thought, there should be a better way to invest in real estate than following all these cycles in the single family realm and apartments and in the tenant toilet business. And so I began looking into self-storage, and I liked what I saw. The numbers are extremely strong. It is recession proof and inflation proof. So when, things are good, people buy more stuff and they have a need for and pile their stuff into self-storage facilities. And when things don't go very well and we're in a recession or during a downturn, then people downsize and they have to move back home or move in with their friends or, shack up with somebody else, or they still have things that won't fit into their new living quarters, which are smaller or that is shared. And so they have a need for storage, and the demand goes up once again. Mm-hmm. And it was a kind of unknown at this, I shouldn't say unknown, but at least in traditional real estate circles, not so many people were talking about it. And so as I began to look into learn how to invest in the business, I could go to the trade shows and learn how to operate them and how to build them. But nobody was really, teaching how to invest in these things and how to evaluate them like the other asset classes. So I got a hold of a mentor, a consultant in the business, and paid him virtually the last amount of money I had in my bank account to learn this side of the business. So I was burning the ships, going all in on storage as we were selling off everything else. And we started buying facilities and continue to sell everything else off. And so I got rid of all my home, my apartment, and just went 100% whole hog into self-storage. And then along the way, much the same as your career path, decided that I really like to teach, and I love to show people how to invest in real estate, and was doing it at my local RIA. And then a gentleman that you and I both know very well, Mr. Paul Bowers, said, hey, we got a lot of people interested in learning about this. I'll help you create a home study system, and we'll get you out there going to some of the other events and local real estate investor groups. And I think this is something that will take off, and it did. And it just I had the blessing of two 60-hour-a-week jobs all at the same time, and so we've been navigating through that for the past 11 years, and now I think we're really hitting our stride and found a balance between now really, we still have to teach people how to get into the business, but we're really focused more on the higher level of a student that we can they come to us are a little more educated, a little more savvy and well-heeled that we can partner on deals with. And so that's the direction we're heading right now. And that I'm at past 25 years of real estate summed up in about 5 minutes.
So for those listening, you know as well as I do that many of them think, well, golly, that's not for me because I don't have a big financial statement. And I don't have a bunch of money to put down and so forth. So let's talk about exploding those myths and the reality of buying self-storage. Do I have to have both of those things?
No, of course not. As a matter of fact, it's easier to get into commercial real estate than it is on the single-family realm because when a bank gives you a loan on a single-family house, if you don't make those payments, they make that based on the fact that you have a W-2 income or your spouse does or enough assets to be able to cover that. Whereas if everything goes to heck in a handbasket, whereas in commercial real estate, when the bank looks down the road in the worst case scenario, if something goes bad within the business or with you as the borrower, they just take the property back and they're happy to have that because now they've got an income producing asset or at least close to it that they can sell to recoup. So they look more to the strength of the property than they do the strength of the borrower in commercial real estate.
So stop there a second. That's something that people don't realize till they get into the industry, that the individual doesn't qualify for the loan. The property is going to qualify for the loan. And if the property won't qualify, then the loan won't be happening. Yep. The income's got to be there, and the loan is based on the amount of net income, which is, of course, something you're going to have to learn, and that's how to determine what you can borrow based on what the projected net income will be when you turn the property around, or in fact when you buy it if it's actually in stabilized condition. But it's not about your financial condition; it's about the condition of the property. How about down payments? What kind of a down payment would we require to buy a unit that is in good condition?
Yeah, well, that's a loaded question, as you know. Most of the facilities that we have bought in the past and still buying and that our students buy are right around that $1 million to $1.2 million. It seems like it's kind of a narrow range, but that seems to be kind of our sweet spot. So anytime you get above $1 million, upwards of some of our development projects are $5, $7, $10 million. Well, traditional funding is 20-25% down. Well, most folks can't ever approach that, and some may be able to drain their retirement in a self-directed vehicle and then do one deal and then be done. But the beauty of not only self-storage but commercial real estate is that there's lots more commas and zeros, and so for you to bring in equity partners and share in the equity, share in the ownership, there's a whole lot of profit to go around if you're buying out the right deal, and a lot of passive investors that are willing to get into these properties and not do the heavy lifting and still get better returns that they would see in the stock market by investing in something that they can see and touch and feel. And so as long as you can wrap your head around, and if you can't, I suggest doing it quickly, wrap your head around giving up some equity so that instead of trying to do it all on your own and making $5 million on the back end, that you split it and you make $3 million, 100% of nothing is nothing. So just learning how to structure these deals and bring in private equity investors that they're the ones that are coming to the table with the down payment and then either backed by a loan or just buying the whole property with private money if it makes sense to do so. So long-winded answer to your question, Ron, but I think I answered what you were looking for.
What's the highest loan-to-value ratio that would be normal for a stabilized property?
Yeah. Well, what's the highest or what's normal?
What's the minimum down is what I'm saying.
Yeah. So we've seen, the Small Business Administration, the SBA loans, they promote that they will go up to 90% LTV on self-storage facilities. And we've seen some, a few of those. They're still falling back into mostly the 85% range, 8% if you're untested in not only self-storage but new in real estate. But I would bank on the fact that if you're using a credit union, a traditional lender, and in some cases even the SBA, that you should expect somewhere around the 75 to 80% loan-to-value range.
Okay, so we got to bring in private investors for the top end, or get a partner like you to come up with it or find the money as well, right?
That is correct. Yep, absolutely.
Or can we get a seller to take back a second for the top end?
Yeah, we see that a lot. And as a matter of fact, that's what we lead with when we begin talking with these sellers because, if they've done a good job, which most of them have, they've built up some equity and they're going to be faced with a huge capital gains check when they come to the closing table. And so if they haven't already thought of it, we will remind them or show them that it is in their best interest to stay into the deal to reduce or at least delay some of their capital gains by staying in the deal. So, we continue to promote that to the seller up into the closing table.
So let's convert that to numbers. Buying a project for $1 million, we get the seller to take back a $250,000 second and get a lender to put up $750 first. Is that what we're saying?
Yeah. Essentially, the lender's still going to want you to have some skin in the game. So depending upon the size of the deal, it may not be a percentage, but $50,000, $100,000.
Mm-hmm.
Sometimes less than that, but they do want you to have some in it. But regardless, if it takes 2, 3, or 4 ways or pots of money to get a deal across the finish line, then so be it. And again, that's the beauty of what we have with commercial real estate and the profitability of self-storage. Is there's multiple ways of doing that, and everybody can get paid.
All right. And suppose I can't qualify for any kind of loan that scares me to death to actually go even try to borrow it. What would you do you don't have to be the one making the loan. You can always get other people to borrow the money by giving them up a little of the equity, right?
Yeah, absolutely. Give up a little bit of the equity, usually, depending upon the marketplace. I don't even want to say usually, but depending on the deal structure, if somebody's coming to the table as a guarantor, they want at least a minimum of 10% of the deal, and the bank will still typically want to see that guarantor having some skin in the game. So we tap our private equity investors that also are willing to put their credit up for these properties in exchange for an additional percentage on the deal, but they're still passive.
Right. All right. Well, let's run down a list of the advantages of being in the self-storage industry, because there are a ton of them.
No tenants, no toilets, and no trash. Those are the top 3, or top 1, if you want to call it that. I mentioned one of them, which is the fact that, there's multiple reasons why I'm drawn to this asset class. One of them I mentioned is the fact that it is recession-proof and inflation-proof. For that reason alone, as a matter of fact, we do better. As an industry, I say the self-storage industry does better during a recession than it does during boom times, because during a recession, there's a huge demand for storage, like it is when times are good. However, the demand, at least the influx of demand, supply stops because the banks aren't giving out loans on speculative deals, meaning development deals. And so you got this increase in demand, but the banks aren't giving out development funds for these. So it's a perfect storm, but we like it in both economies. The fact that when a tenant, it's actually a client, but when a customer in your self-storage facility doesn't pay rent, we lock them out, and then we sell their stuff off after 90 days if they don't pay. And we have the right to be able to do that by law, because we are governed by lien laws, not habitational laws or eviction laws like in single-family homes and apartments where, they don't pay you. Well, the courts will just protect them and take care of them, and, we just absorb that cost as landlords of habitational types of properties. Another is automation. It's a very low labor-intensive transaction to move somebody into a self-storage facility. We're doing these with kiosks now and renting out a self-storage unit in the same fashion or very similar fashion that you would rent a video at a Redbox rental station inside of the doors inside of Walmart. We take their credit card, we take their driver's license and upload all their information. We take their photo, we get their fingerprint, and it assigns them one unit that they have access to. They sign the lease on the screen. It pops up the rental agreement for them. We've got their payment, their picture, their fingerprint, and they have access to only their unit. And it even dispenses a lock for them if they have forgotten the lock. So payroll is the highest line item expense in any business, and in self-storage, we can go into a facility that has high payroll in it, put in this technology, which is also accessible remotely, which allows us to be able to invest anywhere throughout the country and create value in these facilities all over the country just by reducing the payroll and running a tighter shift using technology.
That's pretty cool, like an ATM machine, huh?
Yeah, it is like an ATM machine in all those areas. Yes.
So, so you don't have any tenants and toilets, so you have very little management, and that people rent these things. They don't pay, you get their stuff, so you don't have to worry about evictions or anything like that. And these are long-term investments, and they just continue to create cash flow. And the worse the times are, the better they are. I do remember in the recession of 2008, they actually got better. There were types of commercial properties did very well, and that was apartments and self-storage because people lose their houses. They have to have a place to live and a place to store their junk. So, when you are looking for self-storage units, are you looking for them in good shape, or are you looking for ones that need a turnaround, or both?
Now, like anything, we look at build value. So, yeah, we're looking for distressed properties with distressed ownership and management that they just, it typically is the ones that we like to find and go after are the mom and pop, tired mom and pop who didn't keep up with technology, they didn't keep up with the competition or the industry, and their rents are low, they've got some deferred maintenance, they're not doing the things that they need to do to market and be competitive, and we can come in and implement the best practices that we know how to implement and run and really turn up the NOI on these properties and create value in them. So, essentially like houses and anything else, unless it's, structurally bad, the uglier the better, because we know that we've got more upside to it to fold it into the mix and run it the way that we run them.
So you prefer to buy them in distressed conditions so you can build in equity and then create your build the cash flow, increase the value, and now so you have the equity immediately instead of buying them in stabilized condition and getting a small rate of return and waiting for time to create a value. Well, I agree with that. In fact, that's my approach to all commercial properties. I really don't want to buy anything at retail value. I don't mind selling at a retail value, but I prefer to force my equity into the property. So,
well, that goes back to our other point, Ron, as you know, and for everybody else out here, I guess to explain it a step further is we can only buy one property at retail value, and that's with our own cash, because we won't be able to create enough value in it to pay any equity investors that would bring that down payment. So everything you buy has to have value add in it. Otherwise, there aren't enough returns in the back end to attract to the private equity investors.
Well, so what you're saying is the property needs to have a problem or you're not interested in it.
You got it.
Or the seller needs to have a problem.
Correct. Or both, preferably.
Or both, yeah. Okay, well, what about building these things?
Yeah, we've spent a lot of time in the past 2 years on the development end as well. Through the recession, again, it was a deep one, as we all know, and the banks were very skittish for a number of years. And so we had a huge built up demand for self-storage without a lot of facilities being built. And so we've gone out and found a lot of buildings to be able to convert. That was where we started. So bowling alleys, warehouses, vacant grocery stores, any other type of store that may have gone out of business as a result of Amazon or just the economy in general, and then converted those. And we targeted those first because we've already got 4 walls and a roof, and usually favorable zoning, so it's much quicker to market than it is to start from the ground up by buying a piece of dirt. But that being said, we also have a number of ground up projects that